Every trader enters the market carrying a quiet belief that size equals significance. They assume that only the big moves, the large positions, and the bold risks produce meaningful results. But the market doesn't reward size, it rewards consistency, clarity, and alignment with its own structure. The idea of small trades, big gains challenges the illusion that success comes from force. Instead, it points you toward the truth that the greatest power in trading lies in precision, not magnitude. Small trades remove the psychological burden that so often distorts perception. When the risk feels manageable, the mind relaxes. A relaxed mind sees opportunities more objectively. It interprets price movement without fear, without hesitation, and without the mental fog that accompanies oversized expectations. In this clarity, you begin to recognize patterns that were always there, but previously hidden behind emotional interference. The market becomes less of a battleground and more of a landscape, one that you can navigate with calm observation. Large trades, on the other hand, amplify every emotional bias. They pull you into a reactive state where you are trading not to follow the market, but to avoid loss, avoid being wrong, avoid emotional discomfort. This is the very state that leads to impulsive exits, early entries, and missed opportunities. The irony is that traders take big risks hoping for freedom, yet the emotional weight of those risks is what keeps them trapped. Small trades create space to think, to observe, and to adapt, and in that space, growth accelerates. The market is built on probabilities, not certainties. A small trade allows you to embrace this fact fully. When you stop depending on any single outcome, you start thinking in terms of sequences, patterns, and edges. You shift from trying to control the market to aligning with it. That alignment, repeated over time, compounds into something powerful. Big gains aren't the product of one massive decision. They are the cumulative effect of many well-executed ones. Small trades teach discipline. They teach patience. They teach you to detach from the noise of the moment and connect with the broader structure of price. They strip away the fantasy of getting rich quickly and reveal the real lever in trading: consistency. Every time you act with discipline, you reinforce a mindset that becomes stronger than any single trade, any single outcome. The real gain is not only financial, it is psychological mastery. When you stop chasing large wins, you start thinking like a trader who understands the true nature of the game. You don't need to predict. You only need to participate with a clear plan and controlled exposure. Over time, the small decisions you make with precision evolve into results that appear big to others, but to you, they are simply the natural consequence of thinking differently. Small trades reduce emotional pressure and increase clarity because they fundamentally change the psychological environment in which a trader operates. When the size of a trade is small, the emotional stakes automatically shrink. The human mind reacts to perceived threat, not the actual numerical value of money. A large trade signals danger to the subconscious. It feels like something significant is at risk, something that could affect security, identity, or self-worth. This instinctive response triggers stress hormones, narrows focus, disrupts decision-making, and amplifies fear-based thinking. But when the trade is small, the internal alarm system quiets down. The mind becomes more neutral, allowing perception to shift from defensive to observational. Instead of guarding against loss, you begin to see what the market is actually doing. Clarity in trading is not just about understanding patterns or technical setups. It begins with the internal space to interpret price movement without interference from fear or greed. Small trades give you that space. They loosen the grip of expectation, allowing the mind to process information objectively rather than emotionally. Observing the market becomes easier because you aren't preoccupied with protecting an oversized position. You can evaluate price flow, momentum, and structure without feeling compelled to manipulate the situation to fit your desired outcome. In this state, the market becomes a stream of information rather than a personal threat. When a trader engages with the market from a place of emotional neutrality, subtle details become more noticeable. Price movements that previously looked chaotic begin to reveal consistent behaviors. Small changes in momentum, shifts in volume, and the characteristic way a trend transitions into consolidation all become clearer. These subtle insights are often invisible to traders who are emotionally overwhelmed because fear narrows perception to the most immediate threat. Small trades reverse this effect, opening the mind to a broader understanding of market context. The more neutral the emotional state, the more sensitive and accurate the trader's interpretation becomes. Another important factor is the reduction of impulsive behavior. Large trades intensify the need for quick decisions because the emotional discomfort becomes unbearable. Traders exit too soon because they want relief, or they hold too long because they dread locking in loss. Small trades don't create this pressure. Without the emotional weight, there is no need to react impulsively. You can let the market unfold naturally, allowing setups to complete and probabilities to play out without your own fear disrupting the process. This ability to wait, observe, and respond thoughtfully is one of the most valuable skills in trading, and it grows naturally when emotional pressure is minimized. Small trades also promote consistency, which reinforces clarity even further. When every decision isn't burdened by fear, you can follow your plan with greater discipline. Following a plan consistently creates a stable internal rhythm, something the mind can trust. This builds confidence, not the false confidence that comes from winning a big trade, but the steady confidence that comes from knowing you can execute your process regardless of outcome. With repetition, clarity becomes a habit. You become increasingly capable of seeing the market without distortion. The calmness that comes from small trades feeds directly into better decision-making, and better decisions reinforce calmness. This cycle gradually replaces emotional chaos with psychological stability. When emotional pressure drops the traders, awareness of risk becomes healthier and more balanced. Instead of reacting to the fear of losing, you begin to evaluate risk in terms of probability and structure. Your decisions become grounded in logic rather than emotion. You start to see that the size of the trade does not control the outcome, the quality of the decision does. This shift reduces the attachment to any individual result, freeing the mind to look at the bigger picture. You begin to value process over outcome, which is where true clarity originates. Small trades also reveal your psychological patterns more clearly. When the emotional noise is minimized, you can observe your reactions, biases, and tendencies without being overwhelmed by them. You notice the moments when you want to force a trade. You recognize when you're becoming impatient or when you're projecting expectations onto the market. This self-awareness grows stronger because you're not battling intense emotional surges. Instead, you can watch your own behavior as if from a distance, making adjustments with intention rather than desperation. Emotional neutrality creates a kind of psychological mirror, and small trades keep that mirror steady enough for you to see yourself accurately. Clarity is also enhanced by the reduced need for validation. Large trades often carry hidden expectations, the desire to prove something, to recover losses, to show skill. These expectations distort perception, making the trader see what they want instead of what's there. Small trades detach your identity from the outcome. Without the pressure to validate yourself, you become more receptive to what the chart is actually communicating. You begin to trust the market signals rather than forcing your own narrative onto price action. The less you need from the market emotionally, the more clearly you can read it. Another profound benefit is the expansion of patience. Emotional pressure shortens your time horizon, making you focus on immediate fluctuations. Small trades allow you to sit with uncertainty without panic. Patience becomes easier because the psychological threat is low. When you're not afraid of being wrong, you can let your edge play out over time. This patience naturally improves clarity because you're no longer rushing to make sense of things. You can observe patterns developing, watch reactions to levels, and allow setups to mature before taking action. The market rewards patience, and small trades cultivate it. Perhaps one of the most important effects is the improvement of decision quality. All high-quality decisions share one trait: they are made from a clear state of mind. Emotional pressure contaminates decision-making with doubt, urgency, and fear. Small trades take away this contamination. The mental environment becomes cleaner. Your reasoning becomes sharper, your judgment more grounded, and your interpretations more accurate. This clarity compounds over time, shaping your entire behavior as a trader. Small trades reduce emotional pressure and increase clarity not because they change the market, but because they change your internal relationship with it. They shift your mindset from survival to observation, from fear to understanding, from reactive impulses to grounded decisions. By lowering the emotional stakes, they elevate the quality of perception, which becomes the foundation for every consistent trading success. Consistency matters more than trade size because trading is fundamentally a game of repeated actions, not individual outcomes. A single trade, no matter how large or impressive it appears, cannot define your long-term trajectory. What defines it is the pattern of decisions you make over time. Consistency forms the backbone of that pattern. It builds structure, rhythm, and a repeatable approach that can survive the randomness of market movement. When you rely on trade size to create results, you're putting your future on the outcome of isolated events. When you rely on consistency, you're building results on a foundation that can withstand losses, volatility, and uncertainty. The market does not offer guarantees, but it does offer probabilities. Consistency is what allows you to align with those probabilities. Every edge, no matter how strong, requires repetition to become meaningful. A 60% win rate means nothing if you only take a handful of trades. A statistically sound setup becomes powerful only when it is executed again and again under similar conditions. Trade size does not enhance the edge. It only magnifies the emotional consequences of each outcome. Consistency, however, strengthens the edge by giving it room to express itself across multiple cycles. When you prioritize consistency, you reduce the psychological burden that often leads traders into destructive behavior. Large trade sizes create pressure, and pressure distorts perception. You start hoping, fearing, and reacting instead of observing and executing. By keeping trade size reasonably and focusing on routine performance, you create a stable emotional environment. This stability makes it easier to follow your plan because your decisions aren't being hijacked by fear of loss or the excitement of potential gain. Consistency begins with emotional neutrality, and emotional neutrality is easier to maintain when each trade carries manageable risk. Consistency also plays a critical role in discipline. Discipline is not something you apply only when the stakes are high. It is a habit that grows from repeated actions taken with intention. When you trade inconsistently, taking one trade with full discipline and the next out of impulse, you break the internal pattern your mind needs to trust your own behavior. Consistent execution strengthens that pattern. Every time you follow your rules, even in small ways, you reinforce your internal trust. This trust becomes the psychological infrastructure that supports long-term success. Trade size can't build this foundation, only repetition can. Another essential aspect of consistency is its relationship to adaptability. When you trade with regularity, you get more exposure to different market conditions. You begin to see how your setups perform in trending markets, ranging markets, volatile spikes, quiet phases, and news-driven environments. This exposure builds experience, and experience refines intuition. But intuition only becomes reliable when it's shaped through repetition. A trader who takes only occasional large trades doesn't gather enough data to evolve. A trader who acts consistently creates a continuous loop of feedback, learning, adjusting, and improving. With consistency, you also gain a deeper understanding of your own psychological tendencies. Each trade reveals something about how you react under different conditions. Maybe you notice that you always tighten your stop too soon when the market stalls. Maybe you realize you tend to chase entries when volatility spikes. These patterns are easier to detect when you have a steady flow of trades. Large, infrequent trades hide these tendencies because the emotional intensity overwhelms clear observation. Consistent action provides a more accurate mirror, showing you who you are as a trader so you can refine your behavior intentionally. Consistency also stabilizes performance metrics. A trader who relies on sporadic oversized trades follows a volatile path where equity curves swing wildly. This makes it difficult to measure true performance. You can't tell if your strategy is effective because the results are dominated by a few outliers. But when you trade consistently, patterns in your performance become visible. You can measure your average return, risk to reward ratio, drawdown levels, and expectancy. These metrics guide improvement. They allow you to adjust your approach logically instead of emotionally. Trade size obscures this clarity. Consistency illuminates it. A consistent approach also aligns with how compounding actually works. Financial growth rarely comes from sudden explosions of profit. It comes from many controlled decisions stacked over time. Each small, well-executed trade contributes to an upward trajectory. Even small percentages compound into significant gains when they accumulate through disciplined consistency. Large trades do not produce compounding, they produce volatility. Consistent trades, even if modest, create the steady vertical movement that defines real financial progress. Another dimension of consistency is its ability to neutralize randomness. Markets contain noise, short-term fluctuations that have no meaningful pattern. A single trade can easily be captured by this randomness. However, when you operate consistently, the randomness gets averaged out. Your results begin to reflect your edge rather than the market's temporary chaos. This is why casino games rely on volume. Probability only reveals itself through repetition. Trading is no different. Trade size cannot defeat randomness. Consistency can dilute its effects. Consistency also nurtures patience, which is one of the rarest qualities among traders. When you know you'll be taking trades regularly, you no longer feel desperate to make every opportunity work. You no longer feel pressure to force trades or inflate size to compensate for inactivity. Instead, you wait for the right conditions because you trust the process. Patience becomes natural rather than forced. This shift changes everything. A patient trader sees the market clearly, acts with accuracy, and avoids unnecessary risk. Patience emerges from the rhythm that consistency builds. When you are consistent, you develop a deeper connection to the market's behavior. You begin to sense the rhythm of price movement, the flow of momentum, and the subtle cues that signal transitions in structure. These insights don't come from analysis alone. They come from repeated exposure. Over time, this exposure builds a form of pattern recognition that is far more powerful than memorized rules. It is intuition shaped by consistency, not by trade size. Consistency also reduces the influence of luck. Large trades often produce results that appear impressive but are heavily influenced by timing. A trader may think they are skilled when in reality they benefited from temporary market conditions. Consistent trading, however, exposes your true level of skill. If your approach is sound, it will show up repeatedly. If it's weak, the inconsistencies will become clear quickly. This exposes truth, and trading built on truth grows stronger because it's grounded in reality rather than illusion. A consistent trader also finds it easier to scale gradually. When your process is stable, increasing trade size becomes a controlled adjustment rather than an emotional leap. You can raise your exposure in small increments as your psychological comfort and performance metrics support it. This is how professionals scale. They don't jump from small to large. They evolve from consistent to larger through measured progression. Consistency matters more than trade size because it shapes every part of the trading experience. Emotional, psychological, strategic, mathematical, and intuitive. It provides the repetition necessary for an edge to function, the clarity required for decision-making, and the structure needed for sustainable growth. Probabilities outweigh predictions in long-term success because the market is not a puzzle to be solved, but an environment to be aligned with. Traders often fall into the trap of believing that prediction is the ultimate skill, that being able to forecast the next move somehow elevates them above uncertainty. But prediction is fragile. It relies on being right in a specific moment under specific conditions in a system that is constantly shifting. Probabilities, on the other hand, operate across a series of trades, not a single decision. They embrace uncertainty rather than fight it. The trader who thinks in probabilities understands that the outcome of any individual trade is irrelevant compared to the result of many trades executed with consistency and discipline. When you rely on predictions, you place enormous pressure on yourself to be right. The mind becomes attached to outcomes, and the emotional weight of each trade grows. You begin to interpret market activity through the lens of your expectations, filtering every candle through what you believe should happen. This attachment creates distortion. You ignore signs that contradict your predictions, amplify evidence that supports them, and hold on to trades longer than you should because your ego cannot accept deviation from your forecast. Prediction becomes a cage, trapping your perception within personal expectations rather than objective observation. But when you trade with probability-based thinking, the pressure diminishes. You accept that the market can move in any direction at any time, and your job is not to be right but to execute your edge. This mindset frees you from emotional attachment to single outcomes. You begin to view each trade as just one event in a larger sequence. Losses become data rather than personal failures. Wins become confirmations of process rather than victories of intuition. In this environment, your decisions are not driven by fear or hope, but by the recognition that success emerges from repetition, not accuracy. Probability thinking also leads to better risk management. When you acknowledge that any trade can fail, you automatically size positions responsibly. You no longer gamble with oversized positions fueled by overconfidence in a prediction. Instead, you protect capital because you understand the importance of longevity. Surviving long enough to let your edge play out requires prudent risk management, and prudent risk management naturally emerges from a probability-based mindset. You begin to see the market as a game of small, repeated bets rather than life or death predictions. Another advantage of probability thinking is psychological resilience. When you predict and fail, your confidence takes a direct hit. You start questioning your abilities, your analysis, and your entire approach. But when you operate with probabilities, failing on a single trade does not shake you. You know the outcome is part of the natural distribution of results. You've accepted in advance that losses are inevitable, and because they are expected, they don't destabilize your emotional state. This resilience allows you to continue following your plan rather than spiraling into revenge trading or self-doubt. Probability thinking also sharpens decision-making. When you release the burden of being right, your mind becomes more receptive to market information. You begin to see the structure of price objectively because your perception is no longer tinted by expectation. You can adapt more quickly when conditions change because your ego isn't anchored to a prediction that must be defended. You shift from trying to control the market to reading it with neutrality. This adaptability is one of the most valuable skills in trading, and it can only grow in a mind unburdened by the need to predict. Predictions create emotional turbulence because they tie your sense of validation to the outcome. Being wrong becomes painful not because of the loss itself, but because it challenges your identity as a trader. Probability thinking removes this emotional entanglement. Your identity shifts from being a trader who is right to a trader who executes a process. This difference is huge. When you define yourself by execution rather than outcome, you become steadier, calmer, and far less reactive. Emotional neutrality improves clarity, and clarity improves performance. Probabilities also align you with the way the market truly operates. Markets move in patterns, but no pattern is perfect. Even the most reliable setups fail a certain percentage of the time. A trader who expects prediction-level accuracy becomes frustrated when reality does not conform to expectation. They overadjust, overreact, or abandon their strategy entirely. But a probability-based trader expects variability. They understand that randomness is embedded in the market structure. Instead of fighting randomness, they build their approach around it. They focus on controllable factors, entry criteria, stop placement, risk allocation, and execution consistency. This shift from controlling outcomes to controlling actions is what creates long-term stability. Probability thinking also enhances patience. Predictions create urgency. They make you feel as if you must act now to capitalize on what you think is about to happen. But when you focus on probabilities, you become more selective. You wait for setups that align with your edge because you understand that repeating high probability actions produces results over time. You stop forcing trades, chasing moves, or anticipating patterns prematurely. Patience grows naturally when you stop relying on prediction and start relying on process. Another key benefit of probability thinking is the reduction of cognitive load. Predicting requires constant mental effort, trying to analyze every tick, every formation, every piece of news in hopes of being right. This mental strain leads to fatigue, and fatigue leads to mistakes. A probability-based mindset simplifies decision-making. You no longer need to figure out what the market will do. You only need to recognize whether a situation matches your predefined criteria. This clarity reduces overthinking and allows you to operate with far more efficiency. Thinking in probabilities also makes you more adaptable to changing market cycles. Markets rotate between trending phases, consolidations, volatility expansions, and quiet ranges. Prediction-based traders struggle during transitions because their expectations are built around a particular type of movement, but probability-based traders adapt naturally. They evaluate conditions without attachment, recognize when their edge is less effective, and adjust risk or reduce participation accordingly. Their flexibility comes from a willingness to observe rather than insist. Long-term success in trading comes from embracing uncertainty rather than trying to eliminate it. The market rewards traders who can navigate ambiguity with structure and calmness. Prediction offers neither structure nor calmness. It offers hope and anxiety. Probabilities offer a framework that respects uncertainty, accommodates randomness, and leverages repetition. This is why traders who think in probabilities survive long enough for their strategy to mature, evolve, and compound into meaningful gains. In the end, probability thinking shifts the entire foundation of your trading mindset. It transforms the way you perceive outcomes, manage risk, interpret information, and respond to adversity. It keeps you grounded in process rather than fantasy. It shapes you into a participant who works with the market instead of against it. Controlled exposure strengthens discipline because it forces your actions to align with your intentions rather than your emotions. When your risk is kept within boundaries that your mind can comfortably tolerate, you create an internal environment where discipline can actually function. Discipline is not a heroic act or a moment of extraordinary willpower. It is the ability to follow through on a plan repeatedly without being derailed by emotional impulses. Controlled exposure sets the stage for this kind of follow-through. Without it, discipline collapses under the weight of fear, greed, and uncertainty. Every trader enters the market with some idea of what they want to do, but most fail because their emotional reactions override their plans. The problem isn't a lack of knowledge. The problem is that large exposure amplifies emotions to levels that overwhelm logic. When too much money is at risk, fear takes control. Fear pushes you to exit early, hesitate on entries, widen stops, or avoid trades altogether. Greed also takes control, making you hold longer than you should or increase size impulsively after a win. In both cases, your plan gets destroyed. Controlled exposure is the mechanism that regulates these emotional extremes, allowing discipline to operate without interference. Discipline thrives in an environment where consequences are manageable. If the emotional cost of being wrong is too high, your mind goes into defensive mode. This defense mechanism is built into human psychology. It is not a flaw, it is survival instinct. But in trading, the instinct becomes a liability. The way to neutralize it is not by trying to suppress emotion, but by reducing the size of the emotional trigger. Controlled exposure does exactly that. When the risk is small enough, your mind no longer perceives threat. Without threat, emotional reactions fade. Without emotional reactions, you can follow your plan with clarity and steadiness. Another reason controlled exposure strengthens discipline is that it provides consistency. When your exposure is stable, your emotional state becomes more predictable. You begin to understand how you feel at each stage of a trade, during entries, minor pullbacks, fluctuations, and exits. This consistency builds familiarity. Familiarity reduces anxiety. Reduced anxiety increases your ability to make rational decisions. Over time, the emotional rhythm of trading becomes something you can navigate smoothly. When exposure fluctuates wildly, this rhythm becomes chaotic. Discipline cannot function in chaos, but it thrives in structure. Controlled exposure also reinforces the habit of respecting risk. Every disciplined trader understands that risk is not something to eliminate, but something to manage. By keeping exposure within controlled limits, you repeatedly send your mind the message that risk boundaries matter. Each properly sized trade reinforces the behavior you want to internalize. With enough repetition, respecting risk becomes automatic. This internalization is essential because discipline is not about forcing yourself each time. It is about having automatic processes that align with your goals. Controlled exposure is the training ground where these automatic processes are built. Another important effect of controlled exposure is that it reduces ego involvement. Large positions activate ego because they tie your sense of worth to the outcome. Being right becomes essential. Being wrong becomes painful. This emotional attachment to outcomes is one of the biggest barriers to discipline. When exposure is controlled, the stakes are lower and the ego remains quieter. You no longer need to prove anything through a single trade. You can objectively evaluate what the market is doing instead of trying to defend your identity. Discipline grows naturally in a state where the ego isn't constantly fighting to assert itself. Controlled exposure also enhances patience. When you are not desperate for immediate results, you can wait for high-quality setups. Large exposure creates urgency, an urgent need to win, to recover, or to avoid loss. Urgency destroys patience because it pushes you to act prematurely or irrationally. Controlled exposure removes the pressure to make the market give you something right now. With reduced pressure, you can allow trades to come to you instead of chasing them. Discipline is most visible in the moments you choose not to act. Controlled exposure is what makes these moments possible. Another area where controlled exposure plays a major role is in preventing emotional snowballing. A single large loss can trigger frustration, anger, or panic, leading to revenge trading, over-leverage, or impulsive decisions. One mistake turns into a chain of mistakes. But when exposure is small and controlled, even consecutive losses don't destabilize you. You can absorb them, reflect on them, and continue with your plan. This prevents emotional momentum from building. Discipline remains intact because your emotional state remains stable. Controlled exposure also helps you build statistical confidence. When each trade risks a small portion of capital, you gain the freedom to execute your setup repeatedly without fear of ruin. Repetition is the key to building belief in your system. Belief is essential for discipline. You can't follow your rules consistently if you don't trust them. Large exposure limits the number of trades you can take safely, slowing the development of confidence. Small, controlled exposure accelerates it. As you see your strategy perform over many trades, your discipline strengthens because you know from experience that your edge works over time. Another dimension of controlled exposure is that it gives you room to think. Stress shrinks your cognitive capacity. When the stakes feel high, your mind focuses narrowly on the threat, reducing your ability to process information clearly. Controlled exposure removes this cognitive strain. With more mental bandwidth, you can reason clearly, analyze effectively, and make decisions aligned with your plan. Discipline is not just about resisting impulses, it is also about maintaining cognitive clarity. Controlled exposure supports this clarity. It also reduces the temptation to deviate from your rules. When exposure is large, the temptation to interfere with trades intensifies. You start micromanaging positions, adjusting stops unnecessarily, or abandoning strategies because the emotional cost of letting a trade breathe feels too high. But when exposure is controlled, the temptation weakens. You can let trades unfold according to your rules, which reinforces your discipline and strengthens your execution habits. Controlled exposure also improves your ability to evaluate performance. When trade size remains consistent, you can clearly observe how your strategy behaves. Patterns in your execution, strengths, weaknesses, and areas needing improvement stand out more distinctly. This clarity allows you to refine your approach with precision. When exposure varies, the noise becomes too high to interpret performance meaningfully. Discipline grows when you have accurate feedback, and controlled exposure is what makes that feedback possible. Finally, controlled exposure creates longevity. The longer you stay in the game, the more your discipline strengthens, your skills refine, and your understanding deepens. Traders who rely on large exposure often burn out or blow up long before they develop true mastery. Controlled exposure preserves capital, protects emotional stability, and supports continuous learning. Discipline grows in environments where you can operate consistently over long periods. Controlled exposure is the structure that makes this long-term development possible. Big gains come from repeated, precise execution. Because success in trading is built on the accumulation of small, intentional actions rather than rare, dramatic events. Most traders enter the market searching for the one big trade that will transform their results. But the reality is that sustainable growth comes from a pattern of consistent behaviors repeated over time with accuracy. Precision in execution means acting according to a clearly defined plan, not according to emotion or impulse. Repetition means doing it again and again until your process becomes ingrained and reliable. When these two elements combine, big gains emerge naturally as a byproduct of disciplined structure rather than as the result of luck or aggressive risk-taking. Precise execution begins with clarity about what you are trying to achieve in each trade. It requires a well-defined entry, exit, and risk parameter that you follow without deviation. This clarity ensures that your actions are not influenced by momentary emotions or market noise. But clarity is not enough by itself. What gives it power is repetition. Every time you execute your process the same way, you reinforce the connection between your analysis and your actions. Over time, these repeated actions compound into a systematic approach that functions independently of market randomness. This is how traders develop an edge, not through prediction, but through consistent alignment with their methodology. The market rewards precision because precision removes unnecessary errors. Human behavior is naturally inconsistent, and inconsistency introduces risk. When traders act differently from trade to trade, changing size, shifting rules, adjusting stops impulsively, they create chaos in their results. This chaos prevents them from realizing the true power of compounding. When execution is precise and repeated, the noise disappears and the underlying statistical advantage can begin to work. Big gains are the result of allowing probabilities to unfold through disciplined, repeated decisions made with accuracy. Another reason repeated, precise execution leads to big gains is that it creates data. Each precisely executed trade produces valid feedback. You can measure what works and what doesn't because you are not distorting your results with random decisions. This data becomes the foundation for refinement. When you see patterns in your consistent behavior, you can adjust your strategy intelligently. Improvement becomes intentional rather than reactive. Small adjustments informed by consistent data compound into significant improvements in performance. Over time, these refinements elevate your entire system, increasing the likelihood of larger cumulative gains. Precise execution also helps develop emotional stability. When your actions follow structure, your mind becomes less reactive. You no longer panic during fluctuations, nor do you chase trades during excitement. Structure becomes the anchor that stabilizes your emotions. This stability is essential because emotional trading creates unpredictable behavior, and unpredictable behavior destroys potential for growth. Repeated precision builds an internal rhythm that brings calmness. The calmer your mind, the more clearly you see the market. The clearer you see the market, the more accurately you execute. This loop strengthens over time, supporting long-term growth. Another critical factor is the reduction of impulsive errors. One impulsive action can erase weeks of disciplined progress. But when you commit to repeated, precise execution, you reduce the space where impulse can intervene. You act only when your criteria are met. You avoid reacting to sudden spikes or drops. You stop guessing and start observing. This reduces avoidable losses and preserves capital. Preserved capital compounds. Over time, the absence of large emotional errors creates the smooth equity curve that leads to significant long-term gains. Precision in execution also maximizes the efficiency of your edge. Every strategy has a certain probability of success. If you execute it perfectly, the probability expresses itself accurately over a large sample. If you execute it inconsistently, you weaken the very edge you rely on. Repetition magnifies the effect of precision. Each precise trade becomes one more brick in the structure of statistical advantage. Over hundreds of trades, this structure becomes robust enough to produce powerful cumulative results. Traders often underestimate how small imperfections, late entries, fear-driven exits, inconsistent sizing, erode performance. Precision eliminates these erosions. Repetition amplifies the benefits. Another aspect of repeated precision is that it reduces the emotional significance of any single trade. When you know you will be taking many trades, you stop obsessing over one outcome. This detachment prevents you from interfering with trades prematurely. You let the setup play out because you know it is just one of many. Detachment builds discipline, and discipline supports accuracy. Accuracy supports growth. This psychological shift is one of the most important steps in evolving from random trader to professional performer. Repeated execution also builds confidence. Real confidence, not the kind produced by a single lucky win. Confidence born from repetition is grounded in evidence. It comes from seeing your process work over and over again. This confidence strengthens your ability to execute your plan even under stress. It makes you less vulnerable to doubt and hesitation. With confidence, your actions remain consistent even in uncertainty. This consistency is exactly what allows your strategy to produce large, cumulative gains. Big gains also come from staying power. Repeated, precise execution prevents catastrophic losses, which means you stay in the game longer. Longevity is underrated in trading. Many traders blow up not because they lack skill, but because they fail to control risk through disciplined behavior. If you survive long enough, your edge has time to generate exponential returns. Precision protects your capital. Repetition protects your mindset. Together, they protect your future. Another dimension of why big gains emerge from repeated precision is that it allows you to capitalize fully on favorable market conditions. The market moves in cycles. Sometimes your strategy aligns beautifully with the environment. When this happens, repeated, precise execution allows you to extract value consistently. If you're inconsistent, you miss these windows. Precision ensures you don't waste opportunities. Repetition ensures you capitalize on every qualifying moment. Over time, these windows accumulate into significant long-term gains. Repetition also strengthens your internal timing. The more you execute a setup, the better you understand its nuances. You start recognizing when it is stronger, weaker, or more likely to follow through. This intuition grows from repeated experience with the same structure. Intuition developed this way is reliable because it is built on data, not emotion. This improved timing further enhances precision, which increases profitability. Another important effect of repeated, precise execution is that it simplifies your trading. You no longer waste energy on overanalysis or unnecessary decisions. You act when your setup appears and stay still when it doesn't. This simplicity reduces mental exhaustion and prevents analysis paralysis. A simplified process is easier to execute accurately, and accurate execution over many trades naturally compounds into big results. When traders look at successful professionals, they often imagine complex systems or extraordinary intelligence. But in reality, the foundation of their success is almost always built on simple processes executed with extraordinary consistency. They do the same things the same way, over and over, with precision. Over time, this repetition creates massive cumulative gains that appear effortless from the outside. But the effort is in the discipline, not the prediction. Big gains, therefore, are not the product of intensity, they are the product of consistency. They come from doing the right things with precision over and over. They come from protecting capital, reinforcing habits, reducing errors, and allowing compounding to work. Repetition builds mastery, precision builds reliability. When mastery and reliability intersect, the outcome is growth that becomes increasingly significant as time passes.